In terms of what you're seeing at the headline level of the equity market, similarities to any recent cycles or not?
Look, I think this cycle rhymes the entire 2009 and 10 recovery in so many ways, Wilfred. It's classic, right? The Fed comes in, there's a fiscal stimulus, the lowest quality companies outperform, and that lasts for 12 to 15 months. Then you get to a point where you start anniversarying what happened and you start requiring fundamentals to improve. The quality companies start to outperform. The single most important thing for equity investors in the next 6 months is going to be buying stocks that can expand their margins. That the inflation you mentioned, whether it's wage inflation or input cost inflation, can be offset by revenue growth. If that's the case, those stocks are going to be great. What won't work to make money is just to buy stocks that are cheap on forward earnings and short those that are expensive. That did not work in the last cycle, and I don't think will work this time.
So which types of stocks, Adam, what sectors do you see this kind of pricing power and higher margin?
So it can be all over the market. I generally think there's a lot of long-short opportunity in TMT and in discretionary. I'm a little bit more cautious, I'd say, about industrials because many of them have the input costs to deal with on the commodity side, but maybe can't pass it on, and also have very optimistic expectations. I think industrials are the only sector in the market where the earnings expectations are for double digits earnings growth every single quarter all the way through the end of 2022. So probably estimates are a little bit optimistic there, whereas probably the best way to play it is going to be still in energy and materials where the analysts just lag. They don't bring their estimates up right away, and they can really drive through the pricing.
What do you say, Adam, when you hear people like Morgan Stanley's Mike Wilson say they think that we're due a 10 to 15% pullback for the headline indices? Do you see that as a very, very low probability?
So I'm personally quite friendly with Mike Wilson, having worked with him for a long time when I was at Morgan Stanley. So I would just say there's differing views. I think I don't have the ability to call market corrections of 10% or more. I think that's challenging. What would make me want to call a correction of 10% or more would be signs that there was management hubris, meaning too much capital spending, too much hiring, inventory levels that look like they're going to impede growth, fancy new corporate headquarters, that kind of stuff. I don't really see a lot of excesses in the market right now at all. In fact, I see the opposite, shortages in some area. So I think that's what I would need to see it from a fundamental angle. And on the debt front, there's just not a lot of companies that didn't term out their debt. So I don't see a lot of company-related reasons to be cautious. If you're making a call, the market corrects for some other reason, it's probably about perceptions about growth or rates. And I'm of the mindset that the Fed are the smart ones, that they want inflation, and they're going to let things run as hot as they can for as long as they can. So I don't see that correction coming. I'm more optimistic that earnings are going to grow next year. And my own personal opinion, Wilfred, is you always sound dumb when you're bullish, right? Earnings are growing, the economy's growing, et cetera. And if you want to fight that, go ahead. I don't think you should. I think it's more rosy.
Shepard Smith here. Thanks for watching CNBC on YouTube.